Hey, what's going on, guys? John Fibonacci here. Welcome to my YouTube channel. Today, we've got a video, the top 10 smart money trading rules. So, is there more than 10? Yes, but these are some of my favorites, aka top 10 smart money trading rules. This keeps me out of trouble, keeps me out of taking dumb trades, trades that should have never been taken, and things of that nature. So, hope you guys enjoy the video. Let's get right into it. So the first rule that I tell myself is to not short when there are equal highs. So what does that mean? It means when I see equal highs, okay, or low resistant highs, when I see those, I do not want to take short positions until those highs are taken out. Okay. Now, are there going to be opportunities to short with those highs remaining open? Yes, there will be. However, I just get very uncomfortable. I don't like to trade short when there are equal highs, okay? Because I've been burned many times in the past, and I typically use equal highs or low resistant highs as a target. So if I see those, I don't want to put my stop where everyone else has their stop, because then you're just part of the crowd. That's not what you want to do. You want to be the opposite. Okay, smart money traders are opposite of what retail does, opposite of what the majority of people do. So if I see equal highs, I'm not going to short. I'm just going to wait for a better opportunity. At number 2, the inverse of rule number 1, I do not want to take a long position when there are equal lows or even low resistant lows. Same idea as before. It's just, if that's a target for the downside, if I feel like the market's going to go lower, then why do I want to take a long position? It doesn't make sense, right? So it keeps me out of potentially more losing trades, okay? And, you know, at a minimum, if you can't win more often, at least aim to lose less, less often, you know what I mean? So that's kind of the idea. Equal lows is seen as a target for shorts. Liquidity down there, and I don't want to be a part of that. So when I see equal lows, I don't want to take a long position. All right, at number 3, if we are trading below old lows, I'm not going to look to short below those old lows. Okay, so if we discuss profit targets and things like that, that the algorithm reprices to, or that, you know, smart money is going to be exiting their trades at new lows. Let's say, for example, the market's been selling off or repricing lower, and we get below an old low, previous day's low, last week's low, last month's low, a long-term low, something to that effect. When we get under that, I don't want to take short positions after that, because I've seen the market rally very aggressively coming off of those old lows, and that's just not what I want to be a part of. On the short side, at least. Okay, so I don't want to short below old lows. And number 4, the inverse of number 3, I don't want to buy above old highs. Okay, so I don't want to use a buy stop above an old high. When we trade above previous day, previous week, previous month, or a long-term high, when we're above that, I am reluctant to long, because the probabilities that it will continue higher, price can, and you'll see that happen, but that's just one of the rules of thumb, that if we're above an old high, I don't want to take a long position. It's just we may pull back, smart money may exit their positions, the market may trade lower aggressively, and I don't want to be buying into that. I would rather be exiting longs like smart money does. So if they're getting out, I don't want to be getting in on the same side. So I don't want to be longing above old highs. At number 5, I tell myself, don't place your stop too tight. Okay, so small time frame entries, nothing wrong with small time frame entries. However, if you're too far down into the small time frame, 15 second, even the 1 minute sometimes, if you place your stop super tight, you are more likely to get stopped out. Okay, the closer that your stop is to the market, generally the higher probable that you're going to get stopped out, because your stop is too tight. So one of the things I like to do let's say I'm trading a 5-minute time frame. If I go down to the 1 minute for the entry, I will typically keep my stop at a 5 minute time frame level. Okay, so 1 minute entry, but a 5 minute time frame stop, or maybe even a 15-minute time frame stop, given the parameters of that particular setup. But small time frame entry and medium time frame stop, higher time frame target, and low risk high reward setups are there. Okay, but placing a too tight of a stop loss is not typically good. Okay, you can have trades that run high RR, right? High risk to reward setups, 1 to 5, 1 to 10, stuff like that. But just be careful. Okay, be careful. I've taken trades with too tight of a stop loss, only to get stopped out, and then the market goes in my direction, and I'm kicking myself because now I take a loss when I could have had a nice win. All right, so again, at number 5, I tell myself, don't place your stop too tight. Don't place it too loose either. So there is the other side of that. That's not number 6, but number 5, don't place your stop too tight, and don't place it too loose either. You don't want to have a huge stop loss either. Hey, real quick, guys, before we get to number 6, if you got value so far, drop a like on the video. I would greatly appreciate that. Thank you so much. All right, at number 6, don't choke the trade. In other words, don't overmanage the trade. Moving your stop too quickly. I've done that a lot. Okay. Sometimes I still do it, but I tell myself, don't choke the trade. Let it breathe. Let the trade breathe. Let it run. Give it a little bit of room if it's going your direction. Okay. If I get a wick entry and it starts running my direction, yeah, I might go break even pretty fast. But if I get a little bit of drawdown and then it starts to go my way and it's just being slow, I don't want to choke that trade. Just let it breathe. Let the trade pan out, especially if you're trading at the right time. You just got to give the market some time. You got to be patient, or excuse me, I'm an impatient person by nature. I just always have been that way. And sometimes that is seen in my trading. So I have to remind myself, John, don't choke the trade. Let it run, give it some room to breathe, and don't cut it short on accident. All right. And number 7, take when the market gives. So what does this mean? Well, if I'm in a, let's say, long position, let's say the market is rallying, it retraces, I long, and then the market makes a new high. I'm taking partials. Okay. I may not collapse the trade, but I am going to take partials. So the market gives and takes. Okay. And if you allow the market to take, it will take you. Okay. It will take your stop. It will allow you to have open profit and then take it all away. We've seen moves like that before. You get in, the market goes your way, and then comes back to stop you out, right? But if there was an opportunity to take something out of the market and you didn't, well, you kind of goofed up. So to me, I have to remind myself, if I'm in a long position and the market makes a new high, I got to take partials. If I'm in a short and the market makes a new low, I got to take partials. Or if it hits a longer term low, like a second low or a third low, I'm taking partials. Okay. It's just, if the market gives, I have to take. Coming in at number 8, it's okay to be wrong, but don't stay wrong. So what does that mean? Well, if you're in a trade and you realize after a few more candles have printed, or maybe you come back a little bit later and the market's rather consolidating, or it's not going your direction, and you've reanalyzed the new market data and you realize that your trade idea may not pan out anymore, and you may realize that you're wrong, or maybe you check the higher time frame and you realize that, oh, I'm on the wrong side of the market. That's okay. But to me, what's not okay is to just stay wrong, to let the stop be hit. Well, let's say, for example, hypothetically, you have a 20-point stop or 20 pip stop, okay? And the market's against you about 10 pips or so. And you realize, oh man, I'm wrong. This isn't a good trade anymore. This isn't good, right? Why let the market, if you feel like your stop's going to get hit, a full 20, why not just take the 10 now and move on? Okay, logically to me, it just makes more sense. Now, of course, there's always going to be the argument, well, John, what if it comes back and it would have been a winning trade? That'll happen too. And then, but the other side of that is the same. Well, you now have left the trade on. You could have taken the 10 loss, but now it hit your stop at a full 20. You know what I mean? So there's always going to be that argument of, well, I should have did this or I should have did that. But to me, it's like, if you know with a high degree that your trade is not going your way, why hold on to it? That is so irritating to me. I see some traders, you know, they say, just let the trade hit your stop. Take a full loss. For what though? Why take a full loss when you don't need to? It's unnecessary. It's absolutely unnecessary to take a full loss if you don't need to. So again, it's okay to be wrong, but just don't stay wrong. And you got to admit that. Okay. You got to let your ego aside. Okay. There's no place for your ego in trading. So it's okay to be wrong. Just don't stay wrong. At number 9, this deals with relative strength analysis. I remind myself that I want to long the leader, not the laggard. Okay, if you're not familiar with relative strength, this one may be a little bit confusing. But if you do know relative strength, then if we have a market that is outperforming the other, so if the S&P is making a higher low while the Dow's making a lower low, well, the S&P is being accumulated and the Dow's likely being manipulated. Either way, the S&P is the leader, so that's the one I want to be longing, not the Dow. Okay, and that would be the leader, so Dow would be the laggard. So if an asset is stronger than the other one, that's the one I want to be longing, not the weaker one. Will the weaker one still trade higher if it's a long opportunity? Yeah, it will, but it just will not do it the same. It's just better to long the asset that is stronger and leave the weaker one alone. Last but not least, at number 10, the inverse of number 9, short the laggard, not the leader. So it actually happened today. For example, today's actually Wednesday, April 12th. So I don't know when you're watching this video, but today the Dow on a small time frame made a higher high while the NASDAQ made a lower high. So that indicates that the NASDAQ is our laggard. That's our weakest index, and the S&P was sideways. We actually created equal highs today on an intraday basis. So coming back to one of the earlier rules, right? I'm not going to short when there's equal highs, right? But anyway, NASDAQ would be the laggard. So if we're going to take a short position, ideally it would be on NASDAQ and not the one that's making a higher high like the Dow. And there you have it, guys. Those are the top 10 smart money trading rules that I have for myself. Don't short when there's equal highs. Don't long when there's equal lows. Don't short below old lows. Don't buy above old highs. Don't place your stop too tight. Don't choke the trade, right? Give it some breathing room. Take when the market gives. In other words, take partials along the way. Number 8, it's okay to be wrong. Just don't stay wrong. 9, long the leader, not the laggard. And number 10, short the laggard, not the leader. So if you found this beneficial, share it with a friend. If you haven't liked the video already, go ahead and drop a like. I would greatly appreciate that. It helps me out. And subscribe if you're not already subscribed. That way you can be notified, right, of future content. I go live here 4 times a week right here on YouTube, and you can become a member as well. So thanks guys for watching. I appreciate you, and I will see you in the next one.